So I think to give the people listening to this and watching this some clear pointers. One of the things is, and it's something we say on the show a lot, is do your homework. Make sure that you go in with your eyes wide open in a situation like this. As Grant says, don't assume that because it's a unit trust it's more expensive, or because it's an exchange traded fund on the other side that it's definitely cheaper. Do your homework. And I mean, I'm certainly been someone that's spoken about exchange traded funds for decades now, and they've done very well for a lot of investors, but they're not all exactly the same. That's an important point to understand. There might be some that are tracking the top 40 or the top 50 index that are much more expensive than an exactly almost identical product that is doing the same job but at a much lower fee. So no two ETFs are identical in that sense, just purely from a cost point of view. And then internally, the way that they actually track those indices and how efficient they are is also different. And some of them are much more efficient and therefore do things at a much lower cost than the others. So I think it's really important in a situation like this, do your homework. So, the show today shouldn't stop you from investing in index tracking investments. We think, all of us, that there are a good solution for investors. It's just a case of saying, start by doing your homework, which is what we want you to do anyway. I mean, that's always the deal here. You need to be informed, take control, and then implement. And don't just say, now there's more stuff I need to know about and more things I need to be scared of. You don't need to be scared. You can protect yourself by simply doing a little bit of homework. Like Grant says, these things, these products, almost all of them have what they call fact sheets. And I need to say that carefully. So look at the fact sheet, and then if it's an exchange traded fund, find out what your transaction costs are going to be as well. In simplicity point, that could be a way of doing this. And then for me also, one of the things that you need to do is make sure that once you start this, don't chop and change. Don't try and every time a new product comes into the market, then add it. So now someone's tracking, the top 7 biotech companies in Indonesia. Now you must buy it because it happened to be launched. The point is, if you've got a good, well-diversified index tracking investment, stay with it. It's likely to be your best performer over the next decade or two. Trying to chop and choose between technology, then biotech, then a crypto ETF or a crypto unit trust or whatever the flavor of the month is, that might make you money. It might make you feel good over the short term, but over the long term, kind of, a simple, clear, well-diversified investment that tracks a group of one index or a group of indices. If you want a diversified portfolio, it's probably going to be your best bet time and time again. Might not be the most exciting thing to talk about to your friends, to say that you've bought something fantastic that's so unique, but the point is, we're not in the business of investing to impress our friends. We're there to get to financial freedom.
Actually, I couldn't agree with you more. In fact, there are actually a lot of fund managers out there that actually believe the same thing, whether it be, even active fund managers that like to do the same thing. They like to just buy something to hold for the next 10 years. And one of the reasons why is because, and I think what you're saying has got so much relevance, is that people underestimate the cost of moving. The cost of buying something and selling something in your portfolios quickly adds up. We call that, when we're managing a portfolio, we call that turnover. And what happens is, when you buy something and then you sell something and buy it again, you go through that entire cost cycle again and again and again. And you don't necessarily see it in your portfolio because it doesn't come through in terms of a statement of fees, but it does have a massive impact over the long term on what you're going to get out. So the sort of the common sense theory, and I think it lines exactly to what Warren said, is put something sensible together and try and put together a group of investments that you're going to hold for the next 5 to 10 years. Making short-term changes can sometimes, and in many cases, could cost you more than the gain that you make from that short-term decision.
So I think on that brilliant summary, I think we've run out of time, and so I'm going to leave it there and say to Grant Locke, whose title is head of OUTVest, but internally everyone knows him as the fee terminator, the man who likes to cut out fees. Grant, thanks so much for your time, and I look forward to chatting to you again.
Warren, thank you very much, and I look forward to speaking to you again, and have a wonderful day.